Welcome back to the channel, everyone. Jay here. In today's episode, I want to go over with you some dividend aristocrats. I think it's a great time to buy dividend stocks. I think a lot of them have very depressed valuations, and you can get some long-term dividend growth and stock appreciation growth. Stocks like Walgreens are trading around a 7% dividend. I mean, you can't really beat that, especially as interest rates fall. Then the amount of money you can get in your checking and savings account, that interest rate is also going to go down. So stay tuned for the video. All right, guys, welcome back to the channel. All right, we're going to go over all these dividend stocks. We got Caterpillar, Exxon, Mobil, we got Chevron, McDonald's, Walgreens, Realty Income, which is a monthly paying dividend, which I really like. I want to show you how I value dividend stocks, because you got to not only look at the dividend that's coming out to you and the payout, but you also have to look at the stock's appreciation over time. Because if you're getting, 3 or 4%, but the stock's down 10% every year, you're not really making any money, right? So I want to show you all the steps that I actually use when I value dividend stocks. All right, here we go. Welcome back to the channel, guys. The first dividend stock we're going to analyze today is Caterpillar. Ticker symbol CAT. And what they do is they manufacture and sell construction equipment. They do diesel and natural gas engines and industrial gas turbines. I mean, you see them on the side of the road all the time. They're the big giant bulldozers, all that kind of equipment. So I love Charles Schwab. They have a ton of information that's great for investors. I always like to start out at year to date, right? So they're up 2.4% on the year. We're halfway through the year, so if they did that again, they'd be around 5% for the year, which isn't terrible. And then we want to check out their dividend, right? We're going to go down to the dividend. I like to look at, okay, so the annual dividend yield is only 2%. So if they do 5% for the year, so you're looking at 7%, which isn't a terrible investment considering how safe Caterpillar is. But that 2% dividend, I don't love that, especially if they don't have a good second half of the year. Say the gains that they had in the first half retraces, you're looking at only around a 2% gain, right? Their price to earnings at 18, which is a little high for me for a dividend stock, especially with one that doesn't have a ton of growth ahead of it. And the forward PE is at 13, so they are expected to grow. When you have a price to earnings of 18 and a forward PE that's a little bit lower, that means that their earnings are going to go up, right? That's what they're projecting. So I like Caterpillar. I don't love it. You're getting $5 per share that you own per year. The shares are coming in at $246. So you're not getting a ton of dividend appreciation. So where does Caterpillar land? I'm at meh. I don't hate Caterpillar. I don't hate Caterpillar, but I don't love it either. But it is a very stable business model. So if you're in your 50s or your 60s and you want something more stable, that's not really, there's no volatility really, Caterpillar could be the stock for you. All right, next, let's go check out McDonald's. McDonald's is a stock that, for me personally, I'm heading for the hills for McDonald's. Check this out. PE ratio, oh my God, 32? 32 for McDonald's. So if we go down to the chart and we look at the annual growth, I mean, that is as flat as it gets for revenue, and the earnings are pretty flat as well. We're not seeing a ton of bottom line growth or top line growth. It's a pretty stable business model, but trading at a 32 PE is absolutely crazy. And then we have a 2% dividend, right? So I want to pull it up in my Charles Schwab account just to check out some of the charts. McDonald's is coming in at around $300 a share. They're up 12% for the year, so you got to weigh that in when you're looking at the dividend. You're like, oh, the dividend's only 2%, but you got 12% in stock appreciation, so that you'll be around 15% at the end of the year, right? But that price to earnings at 31, even the forward PE is coming in at 26. I don't like that. PEG ratios, you want them to be around 1-ish. Around 4 is a little high for me. They are beating quarter after quarter, which is great. But 2% dividend, but with 2% and the 12% you already got, you're looking at around 14% for the year at McDonald's. I don't know who's lining up to buy McDonald's at a 30 PE. I sure as hell I'm not. I like McDonald's. I'm more comfortable in that 18 to 20 range because McDonald's is a company that has some pricing power because they have a very loyal brand. So, McDonald's, I'm staying away from McDonald's right now. That 32 PE really scares me, especially for a company where bottom line and top line growth isn't really going anywhere. It's a stable company, don't get me wrong. But do I think the stock's going to appreciate 15-20% a year for McDonald's at that 30 PE ratio? I don't think so. All right, what do we want to do next? Let's check out Pepsi. And Pepsi has a really diverse business model. They don't just do sodas. They do a ton of different products. You're probably eating Pepsi products that you don't even realize that they're Pepsi products. They have a great arsenal of products at that company. And right now they're paying around a 3% dividend for Pepsi. That's not too bad. But the PE ratio for Pepsi is even higher than McDonald's at 38. I really think some of these there's some dividend stocks that are really priced well right now, that there's some value to be had, like Verizon and Walgreens, but there's others like McDonald's and Pepsi. Pepsi at a 40 PE, get the fuck out of here with that, guys. I am terrified of that. Let's check out Pepsi in our Charles Schwab little guy. And look, at a 40 PE, they've only returned 1.77% this year. I don't like that at all. PEG ratio is close to 5. This is even worse than McDonald's. Stay away from Pepsi. Forward PE is at 25. I don't see where that growth is coming on. Like how they're going to, I just don't see it. Guys, I don't see it. I am heading for the hills. So at 2.75% and 1.7, you can make more money in a checkings and savings account like in SoFi. Shout out to all my SoFi fam out there. Let's go, SoFi guys. But yeah, you're getting 3, 4, maybe 5% if you're lucky. With the risk, there's serious downside risk. If Pepsi got cut in half, went down to like $90, $100 a share, they'd still be trading in the 20s PE wise. So Pepsi, guys, if there was stay away even more, I would be running from the hills right now. All right, let's check out the gas companies are another I'm a little scared of. So let's go Chevron first. All right, ticker symbol CVX for Chevron. We all know they are an energy company. P/E ratio is at 8. That sounds a little better than 40. And Pepsi. Who's buying Pepsi at 40 PE? You got to be crazy. I like their dividend around 4%. But this is something that's concerning. Look at the EPS dropping. Boom, 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 boom. That is super concerning. Anytime you're getting into stocks, guys, you gotta look at the trend of where this stock is going, man. So if EPS is just going down and down and down and down and down, that's not good because that means they're making less money on the bottom line. So look, I think energy stocks peaked like a year ago. So look, 65 billion, 65 around in the 60s, and now boom, down to 48. And look, the profits are diminishing. Another thing I want to show you guys is historical data for your dividend players, right? So what you want to do is I like to go click on 5 years out and then go to dividend only and then go to monthly and then hit apply. And this will show you the stability of that dividend. And we're seeing really nice dividend appreciation over time with Chevron, which is a plus. So you always want to see it stable or getting a little bit more money over time. This dates back to 2018, guys. So this is a great way to see if there's a chance that your dividend can be cut. And then to really check is you want to see the payout. All right, so we're going to go to dividend payout, share statistics right here, everybody. I like looking at the short interest, only 1%, which is great, held by institutions. Over 60% is something you always want to look at. And let's see dividend health. Dividends is down here, everybody. Payout ratio is 31%, which is great. So that means they still have room to pay out even more money to shareholders. So I like Chevron in the mid-tier. But you got to be careful with a stock like Chevron because they're making less and less money on the top line. So eventually they might have to cut the dividend or pause that dividend growth. So you always got to be aware of that going in, okay? So energy stocks are very cyclical. We had that boom cycle, and then we could go in another 2, 3, 4, 5-year downward spiral. So we don't know. So you might be able to, if the dividend is stable though, so as the price depreciates, you're going to get a higher dividend yield as long as they don't cut that dividend, right? All right, let's check, just for shits and giggles, let's check out Exxon Mobil and compare them. Ticker symbol XOM for Exxon Mobil. All right, so in the last year, they were 21% on the year. I mean, that's for the past year. Year to date, they're down 1.82%. So that's really interesting. So let's do our little comparison like we did with Chevron. All right. Okay, so they're paying around the same dividend, 3.5%. P ratio is about the same. Look, their earnings are going down too. Boom, 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 boom. And then look, they're even more affected. Their revenue is going down, and so is their earnings. So energy stocks, guys, I'm scared of energy stocks right now. I like Chevron more than I like ExxonMobil right now. So ExxonMobil is going to go to meh. They're always good to have a little bit in your portfolio, but not at these prices for me because their stock price is going to keep going down. Then you can get a little higher yield as that stock price depreciates. All right, let's go to AT&T. All right, for everyone, I want you to be aware that AT&T has recently spun off their Warner Brothers part of their business model to Discovery. Now, that's Warner Brothers Discovery stock I actually really like. But AT&T is a stable company. I like their dividend yield at around 7%. So even if you want to sell a cash cover put around $15, you're going to get that over 7% dividend. Their EPS is a little more stable. But then again, their annual revenue has been decreasing too. But it's a little hard to tell right now because some of that stuff before, 6 months, a year ago, still had the Warner Brothers part of their business segment involved. So that's going to affect their profitability. They actually lost money last quarter. So when your dividend players are starting to lose money, that is a huge red flag. So let's go to historical data. And let's again check out the health of this dividend, right? Bang, we're going to go to dividends only, hit that up to monthly, boom. So this is where the dividend decrease was. That's when the spin-off of Warner Brothers really happened and became official. So it's been stable so far. So they're paying around 28 cents per quarter. So it's coming in $1.11. So we want to check EPS, right? They did 61 cents in dividends. So you times that by 4 for throughout a year. So they're coming around 60 cents. They're going to do around $2.40. So $2.40 in EPS per share, and then you divide the forward dividend $1.11, and that's where you get the payout around, a little less than 50%. So we can, if you don't want to do the math in your head, you can always come down to dividends here, and we can see for some reason it's not coming up in Yahoo Finance. That's why you can do it on your own. If you divide the $1.11 by 240, you're coming in around 40%, and that is super healthy dividend. So I don't think there's any fear of them cutting their dividend anytime soon. You know, I would say AT&T is mid-tier. And next, let's go to Walmart. Pick this up a little bit. Walmart coming in. This is another stock, 37 PE. I don't love that. They're doing $4.76 in EPS, but they're paying out $2.28 in dividends. So that's another around 50%-ish. So that dividend is super healthy. But I like, see, this is a way different chart, right? So if we're looking, check that out. Look, they're making more money and they're staying consistently profitable. So a company like Walmart, I don't love it, especially the 147. So let's pull up Walmart here in Charles Schwab. Let's see how they did through the year. They're up 15% for the year, which is great. So this stock is actually, you know, that and around the 2% dividend. So you're looking at 17% each year, which is great. But I don't think we can bank on this being up 10%. Sorry, I read it wrong. It was $15 they're up in the share price, 11% in stock appreciation. So you're looking around 13%, but the PE ratio scares me, guys. 38. It's super high for a company that's not really growing. If you look at the bottom line, 14 billion, 13 billion, 13 billion, 11 billion. So they do not warrant a price to earnings ratio at 37. You want to get Walmart in the 20s. So you're looking at like between $75 and $90. That's when you want to be buying Walmart, not now. So Walmart is another one. Meh, I don't love. So let's go to Realty Income. This is a monthly paying company that owns a ton of real estate, and they pay out a 5% dividend. So if you divide 5% by 12, that's how much of a dividend you will get each month. And I like the snowball effect of Realty Income. It just keeps growing and growing and growing. And look at this. They're just increasing profits over and over and over. I love this company. I think this is a must-have in a dividend portfolio. So let's just go to historical data. I want to show you guys what I really love about this company. 5 years, and then bang down to dividends, and boom, monthly. Like, look at this, for years, just growing. It doesn't grow a lot, but they're consistently growing the dividend, slowly but surely. So if you can get Realty Income, guys, in that $50 range, $55 range, even at this price at $59, you can scale in slow. I really like Realty Income. And then we're going to do Consolidated Edison. This is another really stable company, 3.6%. And then year to date, you know, they're about even. So you're not making a ton of money on. This is a stable company, but you're not getting a ton of stock appreciation. The PE around 12 is about right, but at 3.6%, I'd rather just put my money in a savings account. Again, SoFi. If you do direct deposit with SoFi, you're getting like almost 5% now. I mean, you can't beat that. Give me that SoFi all day. Edison, meh, I don't like. And the stock that I really like is Walgreens Boots Alliance. Walgreens is one of the most recognizable brands in the country. Them and CVS, they have everything you could possibly need, from prescriptions to, you know, regular consumer goods. And now they're paying a 6.6% dividend. Walgreens stock has really gotten beat up this year. That's why I think that there's, you know, some money to be made with Walgreens, everybody. This is a stock I'm loading up on. Year to date, around 23%. That's insane to me. But their business model's gotten beaten up. But they're a stable business, man. They had a really bad quarter at the end of Q4 of 2022, but they became profitable again in Q1 of 2023. Their last earnings just came out. They weren't great, but I just think that $1.92, you're getting per share at $28. I mean, that's just hard to pass up right now. 6.8%. None of these are super amazing to me, but Walgreens is going to go right there with amazing. I think at $28 a share, you really can't go wrong. Even if you want to sell cash covered puts a couple months out, around $25, if Walgreens touches $25, you're going to be getting like a 7.25% dividend. Another stock I really like that's a dividend is Verizon. That's not on here. Walgreens and Verizon are the dividend players buying the most right now, because I think there's not only a great dividend, but I think the stock prices, both of them, can appreciate 20-25% in the next year or two. So I hope you guys like this video. If you want to see more tier content like this where I can break down a bunch of different stocks, give you a little bit of info on them, let me know in the comments below, and we'll catch you guys on the next video. Peace!